welcome to our webinar. My name is Larissa Greene with Advanta IRA, and I'll be walking you through retirement plan contributions and deadlines for 2023. And we'll also talk a little bit about looking ahead for 2024. And I know really we're into 2024, but when we're talking about tax season, we're really talking about the previous year. And so I'm going to be focusing on that. Thank you so much again for joining me. If you have questions, please feel free to type them into the question box and we'll make sure to get those questions answered as we go. Again, my name is Larissa Greene. I'm with Advanta IRA and I have been with Advanta for almost 12 and a half years now. My contact information is here, so if you're not comfortable putting your questions into the question box to get them answered during the webinar, or you have more specific questions, please feel free to reach out to me. I'm happy to answer any questions you have. This webinar will be recorded, and so you are going to have the ability to review it later on or possibly share it if you choose to do so. And so that will be available usually at the end of today, maybe tomorrow. It takes about 24 hours. Advanta IRA is a third-party administrator for retirement plans and a few other types of accounts, as you'll see as we go through this presentation. We've been in business over 20 years and we have almost $3 billion in assets under management. We have 2 offices. We're here in the Largo or Tampa Bay area of Florida, as well as Atlanta, Georgia, but we can help anybody anywhere. So if you have someone that would like to self-direct, they just have to have a US-based retirement account in order to do so. I actually have clients outside of the US as well. Again, as long as it's a US-based retirement account, you can typically self-direct those funds, and we'll talk about some restrictions on current employer plans, but if it ends in IRA, it can be self-directed. Every one of our clients receives a dedicated account manager, somebody who is there to answer their questions on things like annual contributions and making investments. And that person is with them for the life of the account and assists with things like making investments, paying expenses on behalf of any investments that you hold. And I think that really makes us stand out compared to our competitors. Advanta IRA and its employees do not provide investment advice. We don't provide investment, tax, or legal advice. And so when we're talking about things that you can and can't do, we always suggest getting your professional team involved, your attorney, your accountant, and your financial advisor. But if you don't have those professionals, we're happy to help you with some recommendations from clients that we have gotten in the past. So our clients have worked with professionals that are familiar with self-directed IRAs, and we can give those names out if you do need to add to your professional team. So we're going to jump right in here, and this is a really technical webinar where we're going to be talking a lot about the rules and guidelines and deadlines for different types of retirement accounts. And this is not going to be restricted to self-directed IRAs, although that is our specialty. These rules are particular to the type of account, and they are true anywhere you go when you're talking about the accounts specifically. Here are the different types of accounts we're going to be talking about today. And again, we do focus on self-directed IRAs, but this information is true regardless of whether you self-direct currently or not. We'll talk about traditional and Roth IRAs, as well as employer-based plans like SEPs, Simples, and solo 401ks. We'll also talk about health savings accounts and education savings accounts, and although those are not retirement accounts, the rules for self-directing them are going to be the same, and they're also tax advantage accounts, and so we can help you with those as well. And I really won't be talking much about former employer plans, but just know that if you have an old employer plan, you can typically roll that account into any one of these retirement accounts, so traditional, Roth, SEP, sometimes simple, there's some limitations there, or solo 401ks. And, you know, depending on whether it's a pre-tax account or it has Roth money in it, you may or may not pay taxes for it to go into a Roth IRA. But the advantage is then you have that money available to self-direct. If you have a current employer plan, it's going to be restricted by the plan administrator's rules for that money. So whether or not you can move those funds will be dependent upon the plan itself. So this slide is going over the contribution limits for 2023. And remember, we're talking about strategies for saving for 2023 taxes because we have a few deadlines coming up. I'm sure everybody is aware that when we get to April 15th, that is going to be your tax filing deadline for 2023. And so many of you are still working on your taxes. If you're looking at corporate filings, you may file for extensions, but being aware of how contributions and their deadlines work for each of these accounts might be important to you if you're looking for deductions on your 2023 taxes, or B, you're simply looking to save for retirement and you want to meet deadlines so that you can really maximize your contributions. So we'll talk about each of these accounts and their contribution limits for 2023, and then we'll go into 2024 a little bit, but because we still have time for 2024, I'm really going to be focusing on 2023. I had a few questions pop up here. What paperwork is filed annually with the IRS on behalf of an account holder? And for an IRA, that's going to be any 1099s that apply. So 1099s will apply if you do a Roth conversion or if you take a distribution from the account. The plan administrator or IRA third-party administrator will file your 1099s. And also annually, there's a 5498, and the 5498 basically addresses any rollovers, contributions, and value of assets within the account, and that's filed every year for you as well. You will get a copy, and you want to make sure that you're providing these to your accountant on an annual basis. I had another question pop up about addressing a backdoor Roth IRA. I'm really not going to go into that too much, and especially because that is a more advanced strategy. But when I get to Roth IRAs, I'll touch on it very quickly. But I do have an entire webinar on backdoor Roth IRA contributions and how they work, along with the Roth conversions. So if you would like a copy of that webinar, please feel free to email me and I'll make sure to get you the link to that webinar as well. All right, so let's jump right in. We're going to start with traditional and Roth IRAs, and these are lumped together because as far as what the annual contribution limit is, they are going to be the same. For 2024, the contribution limit did go up, but when we're looking back at 2023 and the contribution you can still make, you actually have up until April 15th of this year to open and fund Roth and traditional IRAs for 2023. So if you have not already done so, and you would like to make an annual contribution for 2023 using a traditional or a Roth IRA, even if you don't have it set up, you can still set that account up and fund it up until April 15th. Now we are getting closer and closer to that deadline, and I know many of you are very busy and paperwork can be a little bit stressful, especially when we get to deadlines. But if you are thinking about establishing these accounts and making your contribution, it's better to do it sooner rather than later, because if the check gets lost in the mail or if it bounces, then unfortunately there's nothing we can do about that. We have to have received the postmark check at our office with a date on it of April 15th. Or if you're sending a wire, it has to be received by April 15th. If you're sending an ACH, it has to be received by April 15th. Sending and not receiving is not going to work for ACH and wires, and the check has to be received with the postmark of April 15th. So you do still have time. I would just recommend not waiting, because all of these things have happened. The ACH was delayed, the wire was delayed, the check was lost in the mail, and so I hate to see that happen if you're looking to fund the accounts for April 15th. The traditional IRA, of course, is a pre-tax account. It's very likely you'll get deductions on your taxes for making your contribution to the traditional IRA. And for 2023, you can do $6,500 or $7,500 if you're over the age of 50. It is a tax deferred account, so basically you get that deduction, you're kicking the tax can down the road, and when you take distributions at retirement, you're going to pay taxes as ordinary income for the amount you distribute in the year that you distribute it. This is a great account because it can accept rollovers from old employers' plans seamlessly without paying taxes and penalties. And it is also a great account for those deductions, as I mentioned. The Roth IRA is an after-tax account, and so when you make your contribution, you do not get a deduction, and that's an important note, because if you're looking for tax-saving strategies for 2023, the Roth IRA is not going to save your taxes, but it does have the benefit of growing tax-free. So when you reach retirement age, as long as you're 59 and a half and you've had a Roth account with contributions for a minimum of 5 years, then it would be a qualified distribution. And when you take monies out, no taxes will be paid. And as long as you're over that 59.5 and the account has aged for 5 years, no penalties will be paid. And so it is a great account for that, but it isn't going to get you any deductions when you're making contributions. Again, remember, you have up until April 15th, so we can help you establish an account and you can make your annual contribution. And as we get closer to that deadline, our recommendation for ways to get the contribution to us is going to change. You know, an ACH, again, is a great way to make a contribution, but it can be delayed. It takes several days to clear. And so if we're getting closer, I'm going to suggest definitely a wire or a postmarked check. And then even still, a wire can be delayed. Now I'm going to talk a little bit about a SEP IRA, which is an employer plan, is an employer-based IRA account. And again, just as a reminder, if you have any questions, please feel free to type them into the chat box. So deadlines and contributions for 2023. You actually have until the sponsoring businesses tax filing plus extensions to open and fund a SEP IRA for 2023, which means you have up until October 15th, 2024. The maximum contribution for 2023 is $66,000 or 25% of your compensation, the lesser of the two. And that's going to be super important here because it is a formula of your income, which means if you made $100,000 this year, you can't automatically put $66,000 in. It's going to be 20 to 25% of your income. The difference in those percentages is going to be dependent upon how you pay yourself and how your business files, or if you have a formally established entity. That is going to definitely be a question for your accountant. Have them help you calculate your SEP contribution, and then you can get that money in there. It is a pre-tax contribution at this time. And the reason I mention that is because I know with the Secure Act 2.0, they did allow for Roth contributions to the SEP IRA. However, at this point, we are still waiting on clarification for record keeping for Roth contributions made to a SEP IRA. So currently, they are still pre-tax. That is the same across the board, no matter where your SEP IRA is. And the IRS, once they give us guidelines for record keeping, then administrators like Advanta will be allowed to allow Roth contributions to the SEP IRA. So we're just waiting for that clarification. I think that they did hand down some information at this point, but not enough clarity for us to accept them. So as soon as that happens, I'm sure we'll do a blog article on it. We'll probably do another webinar to update you on how that will work. As soon as we have that information, we'll pass it along. So currently it's still a pre-tax contribution, but that's great news because it's going to get you a deduction for making that contribution. And the really cool thing about a SEP IRA is even though you're making a contribution and possibly maxing out this contribution, you can still also have a traditional IRA or a Roth IRA. And as long as you had enough in earned income to justify contributions to both, you can make both the SEP contribution and a traditional or Roth IRA contribution so that you can really either maximize your deductions or just very simply, if you're making Roth contributions as well, maximize contributing to a retirement plan. Now we're going to talk about a simple IRA, and it is going to be a little bit different than the SEP. Remember the SEP, we mentioned that you can make your annual contribution and even set up the account all the way up till your tax filing deadline plus extension, so potentially all the way up until October of 2024, and that's for 2023's contribution. But when you're looking at the simple IRA, the rules are a little bit different. And just a second, before I go into the simple IRA, I had some questions on the SEP I want to address before we go into the simple. So the SEP IRA Roth contribution made by the company added to income for the beneficiary that year. So that's a great question. And like I said, right now, we don't have a ton of information on how the record keeping is going to happen for Roth contributions to the SEP IRA. We're still waiting on some clarification. But my best guess is that yes, it's going to be considered ordinary income. There's not going to be a deduction because this is going to be treated very similar to the Roth IRA. And remember, whatever contribution you make to your Roth IRA is still going to be considered ordinary income for that year. No deduction is granted for Roth contributions, and that's probably going to be the same for the SEP IRA. There's not going to be a deduction granted, and so it would still be considered income. Now, how that will be handled, I'm really not entirely sure. So again, we're waiting for some clarification on that. I had some more questions pop up here on solo 401ks and HSAs. I'm going to wait to address those questions until I get to those accounts, because we're going to talk about those, and I may address your questions there at that time. So again, jumping back into simple IRAs, the contribution limit for a simple IRA for 2023, remember this is all for 2023, is going to be $15,500. If you're over the age of 50, you get an additional $3,500. That's your catch-up contribution. And then the employer gets up to a 3% match. Now, this is between 1% and 3%. It depends on how the simple IRA is set up. And for the simple IRA, if you're looking to start a new simple IRA, unfortunately, if it's for a 2023 contribution, this account needed to be set up by October 1st of 2023. If you have an existing simple IRA, you can still make your 2023 contribution. But if you're looking to set up a simple, it had to have been done by October 1st of 2023 in order to make the 2023 contribution. Then when we're talking about an existing simple IRA, you have up until January 31st of 2024 for employee contributions. Employer contributions can be made as late as tax filing plus extensions for the employer. So that means all the way up until October 15th of 2024. So again, it's too late to set up a simple for 2023, but if you have one existing, you can make your contributions. You'll still get the opportunity to make the employer contribution. The employee contribution needed to be done by January 31st, but the employer contribution has all the way up until the employer's tax filing plus extension, and the employer contribution is that 1% to 3%, or the employer match as we like to call it. I had another couple questions pop up for a SEP IRA, so I'll address those now. Can I contribute to, hold on just a second, it's jumping around, a SEP until October of 2024 for 2023? Yes, you still have time. And if the employer is filing extensions, because this has to do with extensions being filed, if the employer is filing tax filing extensions, you have up until extensions to set up and contribute to the SEP. So you do still have time if you're filing extensions. It's going to be up until tax filing. So up until tax filing plus extensions for the SEP IRA, and that would still be for 2023. And we do set up SEP accounts. Yes, we can definitely help you with that. I had another question on the 20 to 25%. It's 20 to 25% of the employee's earnings for the year. So again, this will probably largely depend on how your business is set up. So are you a sole proprietor? Do you have a formally established entity? How do you pay yourself? Because that 20 to 25% for the SEP contribution is going to be dependent upon that and how you do that calculation. And again, that's where you're really going to want to get your accountant involved in helping you determine that contribution. A question popped up again on forms filed. So for anything that is considered an IRA, we are going to generate the 1099 and the 5498. So anything that's considered an IRA will get a 1099 if it applies, and a 5498. And the 5498 again is sort of details on rollovers received to that account from other accounts. It also includes contributions made and annual value of assets within the account. And that is filed by Advanta. So again, just readdressing the simple IRA, it needed to be set up October 1st of 2023. If it's going to be a brand new plan, if it's existing, you still have time to make your employer contribution, and you have all the way up until tax filing plus extension, which could go as far out as October 15th of 2024. If you're looking to set up a simple for 2024, for the tax year 2024, you still have time. So we can help you set that up, get it established, and you can start making your 2024 contribution. So now we're going to look at the 401k, and we talk very specifically about a solo 401k because those are the types of 401ks that we administer here at Advanta. We hold accounts for sole proprietors and independent business owners with only spouses as employees. So if you own the business, if you're a partner in the business, partners would apply here. We can hold 401ks for partners and business owners, and then spouses as employees only. If your children are your employees, you cannot have a solo 401k if the employees qualify for the plan. So keep that in mind, because sometimes people say, well, it's just my kids, so it should be fine. And that is actually not the case. It's only spouses as employees. So if I were self-employed, I own my own business, and my husband worked for my business, we could have a solo 401k because I'm the owner and he's the spouse as the employee. And so that would work for us. But if our children were also employees of my business and they would qualify for the plan, then we could not have a solo 401k. We would need a plan that would be considered a larger plan that allows for employees, which Advanta IRA does not offer. So here is some information on how contributions are made and tax filing deadlines for contributions. So for 2023, the employee contribution is $22,500. If you're over the age of 50, the employee can make another $7,500 contribution for the catch-up. And the employer can do, again, 20 to 25% of total income. This combined total cannot exceed $66,000 or $73,500 if you're over the age of 50. Now, our plan allows a third type of contribution that will allow you to get all the way up to the total contribution limit as long as you had it in earned income. I'm not going to talk too much about it today because we're looking more specifically at deadlines, but if you have questions on that, I do have a webinar on the solo 401k where we talk about all the types of contributions you can make to a solo 401k. But that is essentially considered a non-Roth after-tax employee contribution or salary deferral, okay? So again, $22,500 for the employee. That should have been made by January 31st. So the plan needed to be established by December 31st for the employee contribution, and the employee contribution typically would have needed to be made by January, although I do think, actually now that I say that, you have up until tax filing plus extension with the new Secure Act 2.0 rules, as long as the plan was established by December 31st. You can still establish a solo 401k for a 2023 employer contribution. So if you don't have the solo 401k established, you can still do that, but you've missed the opportunity to make the employee contribution. The employer contribution can still be made even if you're setting up the solo 401k now, up until the employer's tax filing plus extensions, okay? If you have an existing solo 401k, so it was existing in 2023, then you can still make the employee and employer contribution up until tax filing plus extensions. And again, consulting with your accountant here is going to be very important. They can help you with the deadlines and they can help you calculate your contributions. The employee contribution on a solo 401k can be considered Roth. That's actually something that's been allowed for quite some time, as long as your plan allows it. So Advanta's plan does allow the employee contribution to be considered Roth. The employer contributions, similar to simple and SEP Roth contributions, is not something we can currently accept until the IRS gives us further clarification on record keeping for that, although it was allowed again with the Secure Act 2.0. I had some questions pop up, so I'm going to review them really quickly. I had a question for the slides from the presentation. If you would like the slides, I'm happy to share them. Please send me an email and I'll make sure to get those over to you. I will be addressing that as I receive requests. So if you could, please make sure to just send me an email. I had a question pop up on a solo 401k webinar. We have done them a few times a year a few times a year as long as I can remember. So I'm happy to send you a recording to one. Again, just send me an email and remind me and I'll make sure to get that out to you. Could a one-member LLC have a SEP IRA? Yes, you can do a single-member LLC as your employer. You can be a sole proprietor. You don't have to have a formally established entity. As long as you have self-employment income, you would qualify for a SEP, a simple, or a solo 401k, and that self-employment income has to be something that you are paying FICA tax on, so that's going to be really important. I had some questions pop up about the solo 401k here. Regarding a 401k, can the employee contribute 100% of their salary up to the contribution limit, even if there is no employer match? Technically, this $22,500 is considered the first $22,500 of compensation. So technically the answer is yes. However, I would definitely defer to your accountant on your contributions because there is going to be some items dependent upon how you pay yourself and how you file. So yes, if you only made $22,500 this year, you could potentially contribute that whole amount to the solo 401k as the employee, but you might have to consider some deductions first and some other items that I'm not aware of because I am not a CPA or an accountant. So I would definitely defer to your accountant here. And you don't have to make an employer contribution. It is not a requirement. And so you can make one or the other. You don't have to make both. Another question that popped up here. How does the 20 to 25% employer contribution work? I don't like to call this a match. It's kind of a profit sharing contribution is really how we refer to it. And so you don't have to have an employee contribution to make the employer contribution. But again, whether or not you can make 20 to 25% is going to be dependent upon how your business is set up and how you pay yourself and how you file. And so I would defer to your accountant on how that contribution works, but it is considered a profit sharing contribution and not a match. So you don't need the employee contribution in order to make the employer contribution. So you can still set up the solo 401k now, and since it would not be eligible for an employee contribution, you can always just make the employer contribution. I think that answers your question. Just let me know if it does not. You can still also have a Roth IRA or a traditional IRA along with your solo 401k, and you can still max them out as long as you have enough earned income in order to do so. Again, this is where your accountant or your tax professional is going to come into handy in helping you make your contributions. I see more questions about the backdoor Roth IRA, so I will address the backdoor Roth IRA and conversion questions at the end of the webinar. I want to make sure I give plenty of time for this subject we're talking about today. There's questions on here about the HSA, and I'll address those soon. A question popped up, does Advanta offer the 401k as Roth? Again, the employee contribution is eligible to be Roth. The employer contribution at this time is going to be still considered pre-tax. However, our plan not only allows the employee Roth contribution, it also allows for you to do an in-plan Roth conversion. So if you're making an employer contribution and it has to be pre-tax, you can immediately convert it to the Roth portion of your 401k if you choose to do so. A question popped up about how the deduction works for the solo 401k. This is really going to be a question for your accountant. I don't want to say that it's a tax credit or a deduction because I know those terms technically are not interchangeable, and so I feel more comfortable if you talk to your accountant about how pre-tax contributions to the solo 401k work in getting you those deductions. But again, if you make a pre-tax contribution as the employee and the employer, you're likely going to get deductions for those contributions. Okay, we're going to move on here because I don't see any more questions about the solo 401k. And again, I will address any backdoor Roth conversion questions at the end because I want to give plenty of time to the subject we're covering today. As of 2020, I just want to mention this again, as of 2020, 401ks can be established up until the employer tax filing deadline plus extensions, and the employer can still make the contribution, and we talked about that. If it was set up as of December 31st, you can make the employee contribution up until tax filing plus extension. We're going to talk now about education savings accounts, or CoverdLs, as they are sometimes referred to. We also like to call them ESAs. Sometimes people refer to them as CSAs. So they have a lot of different names, but essentially what they are is an opportunity to make contributions for a loved one where you're saving for education. The education savings account has more qualifying expenses than something like a 529 plan, and it can be used in conjunction with a 529 plan. 529 plans cannot be rolled into an education savings account. I know a lot of times people will ask that question, and unfortunately they don't work together in that way. So education savings accounts are completely different. They're not state-sponsored plans. These are basically plans that allow you to save and take distributions for qualified education expenses, where they act very similar to a Roth IRA. Making a contribution does not get you a deduction, but as long as those distributions are for qualified education expenses, then you will have that money come out tax-free, and it grows tax-free. So there is a benefit there as well. You can still set up and contribute to an ESA for 2023 up until April 15th. Unfortunately, the contribution limit is only $2,000 per child, and it has not gone up in all the years that I've been with Advanta. And so that is something that is unfortunate as far as, being indexed each year. Many of the accounts are, but an ESA has not been changed in all the years that I've been doing this. So the benefit right now for an ESA especially is because you can contribute both for 2023 and for 2024. And so if you wanted to do that and sort of lump fund this account, you can get $4,000 in it right now, and then maybe potentially partner your ESA with an IRA in order to make investments, or you can review our webinar on making investments with smaller balances. Do you need the name of the beneficiary when setting up the education savings account? You do. You do have to set it up in the name of the beneficiary. A really cool thing about an ESA, though, is you can change the beneficiary over time. So if that money doesn't get used for the first beneficiary, you can change it. And so, for example, in my case, I have 3 children. If my oldest does not use that money, I can change the beneficiary to my oldest daughter, which is my middle child. And if she doesn't use it, I can always reassign this account to the youngest. And so I can move that money down the line if it's not used in its entirety, in order to still retain those tax benefits for distributions for qualified education expenses. There was a question on whether or not it makes sense to start an ESA if you can only contribute $2,000 versus having fees on the account. I always answer that question with, it's completely up to you. If you find there's a benefit of making the contribution, even though there are going to be fees, because maybe you have an idea, you have an investment that is going to make sense for this account, then certainly, and like I said, you can partner your ESA with an IRA in order to really maximize making investments through this account. So even if it is considered a disqualified person, as long as you're going into the investment new to you, and new to the beneficiary of the ESA, you can partner those accounts, and the ESA would receive a pro rata share of the investment that it's making. So it's super important to understand the rules, and then you can make them work towards your benefit. And so you have that advantage of saying, okay, well, maybe there's not enough money in the ESA to invest in real estate, but if you're using your IRA to invest in real estate, you can partner the ESA with your IRA in order to make that investment. Okay, so I know I had some questions about health savings accounts, and I am going to go through this slide and maybe answer your questions as I go, but if I don't, I'm also going to address those questions at this time. A health savings account is a great account because it's considered triple tax advantage, and it does actually have some advantages over IRAs as well that we'll talk about. It's considered triple tax advantage because you make a contribution and get a deduction for making that contribution. It grows and it's tax-free as long as your distributions are for qualified medical expenses. So that's where that triple tax advantage account titling comes from. And it is unfortunately not a way to self-insure. I've been asked that as well. A health savings account is an account that you are qualified for because you have a high deductible healthcare plan that allows contributions to the health savings account. And sometimes employers that offer high deductible healthcare plans will also help you make contributions to an HSA, which is great, but you can do them on your own. For 2023, an individual contribution is $3,850 with a $1,000 catch-up. The family contribution is $7,750 again for 2023. And I know the next question is going to be, how do you know how much you can contribute, either individual or family? And that's going to be dependent upon the plan that you have. So the healthcare plan that you have, is it individual? Then you can make an individual contribution. Is it for a family? Then you can make a family contribution. You can make a 2023 contribution as long as your qualifying healthcare coverage was established by December 1st of 2023. Not the HSA. The HSA can still be established and funded today if you want it, all the way up until April 15th. But you had to have qualifying healthcare coverage by December 1st of 2023 in order to make the 2023 contribution. And then you have to maintain that plan for the following 12 months in order to keep the entire contribution in the plan, okay? So that's very important. And if you already had that healthcare coverage in place by December 1st of 2023, then you still have up until April 15th of 24 to open and fund your HSA for 2023. Another advantage of the HSA over many of the accounts is that you do not have to have earned income for making your contributions. If you have passive income, you still qualify to make an HSA contribution, which is really cool because IRAs, solo 401ks, they do not allow that. I had another question on an HSA pop up. Can I set up an HSA plan in business if I have a high deductible healthcare plan and a full-time job and can contribute lesser there? I'm not really sure of your question here, if you want to maybe pose it a different way, but I think you might be asking if you're making contributions to a business plan, can you still have an HSA? An HSA is going to be for the healthcare plan, and your contributions are going to be limited based on the type of plan you have. And so if you have a high deductible healthcare plan that is provided by your employer, as long as that HDHP allows contributions to the HSA, you can make those contributions personally. It doesn't have to be made by your employer. Sometimes employers offer that as a benefit, but this is still an individual account. And so if your employer offers a high deductible healthcare plan that allows you to make contributions to an HSA, you independently can set up the HSA and make your own contributions and take advantage of that triple tax advantage account. Can each spouse contribute to an HSA? The spouse's opportunity to contribute to an HSA is going to depend on their health care plan eligibility. And so if you have your own health care plan for a single individual and, or I should say individual, excuse me, and your spouse has their own health care plan for an individual, these are not family plans, then you can each make your individual contribution, I believe. I actually will have to look that up, but I am pretty sure that that would be an accurate statement. If you have a further question on that, please email me and I will look up the answer to that question. But if your plan is an individual plan, you're going to be limited to the individual contribution. If it is a family plan, you can make the family contribution, but your maximum is going to be the $7,750 for the family. You do, as the holder, get the $1,000 catch-up, and your spouse can make the $1,000 catch-up separately as well, but you would be required to have them make the contribution for the catch-up in an account in their name. So that's a little bit different. I had a question on fees for the solo 401k. If you would email me, I'd be happy to send you information, but on the solo 401k, it actually does depend on how much record keeping you want us to do versus how much record keeping you want to do, and so the fees are going to vary. I had another question on an HSA. Do we give a debit or credit card for the HSA for medical expenses? We do not. That is not something that Advanta does. We just ask that you request the distribution, and then we pay the distribution where you ask us to pay it. You can reimburse yourself, or you can ask us to pay the medical bill directly through the distribution. HSA money is carried forward. You do not need to use it in 1 year. So that was a question I had. You can carry the HSA contributions in the account pretty much as long as you want. I don't know of a deadline, and you can basically save up your receipts for medical expenses and then take distributions in future years as well. So you do have the ability to take those distributions in the future as long as you have evidence of those qualifying expenses. And so there's an advantage for that as well, where you don't have to use, it's not a use it or lose it or anything like that. I know some health spending accounts are like that, but an HSA is not like that. How much wages limit how much you can move to a Roth or traditional IRA? So there is income limits on those, and we'll talk about that. I really don't have a plan to talk about that for this webinar, but again, I'll touch on some of these questions at the very end of the webinar. I just want to keep moving to make sure we cover the content for today. What type of requirements do you need in order to contribute to IRAs for children? They do have to have earned income. So that's super important if you're making contributions for kids. In IRAs, a lot of times people want to set up a Roth IRA for their children. They do actually need to have earned income. They do not need earned income to have an education savings account, but they do need to have earned income in order to have a Roth IRA or a traditional IRA. Can you use an HSA to pay medical insurance? I'm guessing you mean the premium, and I don't believe you can use the HSA to pay the premium. I think the premium is not a qualified medical expense. But again, the HSA, my associate Alex is actually our HSA in-house specialist, and I'm happy to connect you with him, but also he has done several webinars on the HSA and can definitely answer your questions in more detail. But I don't believe that your premiums are something you can pay with HSA money. I think only qualified medical expenses are going to apply there. Another question popped up, can you contribute tax-free for HSA healthcare? Again, your contribution is made and you get a deduction for making that contribution. The money grows tax deferred, and as long as you're taking the money out for qualified medical expense, then you're going to get, it's going to come out tax free. Okay, so if you take distributions from the HSA for non-qualified or unqualified expenses, they're not going to be considered tax free. Somebody asked me if a Roth IRA is a taxable distribution. It is not taxable as long as two things are true. You have reached 59 and a half and the account has aged for 5 years. So those two things must be true. If you're doing Roth conversions, they carry their own 5-year aging. If you do not wait until 59 and a half and you do not wait until the account has aged for 5 years, if you take out more than contributions, you're looking at taxes and penalties. So your annual contribution can always come out tax and penalty free above and beyond. So basically earnings in that account are not going to be tax and penalty free unless you're 59 and a half and the account has aged for 5 years and Roth contributions, or excuse me, Roth conversions have their own 5-year aging. Thank you guys so much for all the questions. Keep them coming. I'm going to address them as I go. And again, like I said, I do want to keep the webinar moving. So I'm kind of just reviewing the questions as I move ahead. I had some more contribution questions for solo 401k. So in a solo 401k, employers contribute to a regular 401k. Can you immediately convert that to the Roth bucket? You can. So the employer contribution, again, at this time is going to be considered a pre-tax contribution, but you can immediately do an in-plan Roth conversion and convert that over to the Roth bucket and have it grow tax-free. Remember that it's going to be a 1099 in order to pay the taxes on that Roth conversion. So you're going to receive a 1099 for doing the conversion because you do have to pay the taxes. So if you're going to do the Roth conversion, talk to your accountant about how taxes are paid. So let's get into looking ahead for 2024 and your taxes and your tax liabilities in 2025. So some accounts can be open and funded into 2025 if you're looking at 24. Wait, because remember, the simple IRA has a specific deadline. It has to be opened by October 1st of 24 if you're making all of 2024 contributions. The solo 401k has a December 31st deadline if you're looking to make employee contributions. So you do have deadlines. So although we have plenty of time for your 2024 taxes and your 24 tax liabilities, you do want to keep those deadlines in mind and start, sooner rather than later. Contribution limits generally increase every year for many of the accounts. So remember, I specifically talked today about 2023, and the reason that I did was because we're talking about saving on your 2023 taxes. But if we looked at contribution limits for 24, they have changed for SEP IRAs, solo 401ks, simple IRAs, HSAs. And so you want to be aware of those changes so that you can really take full advantage of tax benefits for those accounts. So they also did change for traditional and Roth IRAs this year as well. And so for some of the contributions, if you make them Roth or after tax, you're not going to get deductions. But if you want to take full advantage and really maximize your contributions, you need to be aware of what they have changed to, and some of them do change every year. Again, don't wait, consider spreading out your contributions. If you establish your 2024 accounts now, even if you're not looking to make last year's contributions, you can spread out making your contributions monthly, quarterly, whatever is more convenient for you. Sometimes it's not especially convenient to fund an account all at once at the end of the year or during tax time. So coming up with that contribution might be difficult, especially if you do have a tax bill. Many accounts can be combined to maximize your benefits. So depending on your eligibility, you can have a solo 401k along with a Roth IRA, along with an HSA, along with an ESA. So you can really max out accounts as long as, in most cases, you have the earned income to justify those contributions, and as long as you qualify. So again, depending on your eligibility, you potentially can have many of these accounts and they can work together. You can make any of the investments that Advanta can hold on your behalf, and I'll just touch on this very quickly, and then I'll go back to questions because I see many questions popping up. I know we're getting to that tax filing deadline, and so we're sort of wanting to get as much information as we can to really maximize any benefits before that deadline. Just remember that a self-directed account, and now this is going to be specific to Advanta, where a lot of the information I shared before is specific to the types of IRAs. Now we're going to be talking about assets specific that Advanta can hold. So of course, real estate, single family homes for long-term or short-term rentals. You can also fix and flip in your retirement account with Advanta. You can hold condos, duplexes, mobile homes, and mobile home parks. You can invest in tax liens and deeds. You can invest in real estate investment trusts and syndications, commercial property, and multifamily. On the paper side of assets, we see clients hold mortgages. They bid on and hold tax liens and tax deeds, as I mentioned on the previous slide. Your notes do not have to be secured by a mortgage or a deed of trust. They can be unsecured. We're going to leave that up to you. You want to vet your investments, do your due diligence, make sure you feel comfortable with the investment and the investment provider or borrower on that investment. We see debenture notes and option contracts, and that can be something like a real estate option, assignments and joint ventures, accounts receivable. All of these are assets that you can hold within a self-directed account. It can be an IRA, an HSA, an ESA. And so when we talk about even using smaller amounts of funds to invest, something like a joint venture, accounts receivable, tax liens, notes, assignments, all of these can be done with limited funds, option contracts, and so that you can still make those funds work for you. Alternative assets include things like LLCs, whether it's a single member LLC, just simply for checkbook control, or investing into a subscription with a company for a syndication or a limited partnership. We also see people invest in things like cattle, alpaca, racehorses, and we see partnerships. I've seen TV and movie projects. We have clients that hold precious metals like gold and silver bars and coins. We've seen equipment leasing, so things like large format printers, ATM machines, tractors, and other farm equipment. Forex, and if you're not familiar with that term, foreign currency exchange, private stock. So we do not hold anything publicly traded, but we can hold private stock, and we do so for clients in wineries and breweries and local restaurants. And sometimes it's not a local restaurant, but it's simply something that is private stock. We also see private stock in banks and other different types of business private stock, commodities, and oil and gas. And again, as long as it's not publicly traded, it's very likely something we can help you with, because the IRS only says that you cannot invest in life insurance or collectibles, and then they also prohibit certain family members that you can't transact with. I'm switching over to this slide so that you have my contact information. Here it is. Again, please reach out to me. Send me a quick email if you'd like a copy of the slides. That's the fastest way for me to get them to you. Here is my email address, my phone number, and extension if you have more specific questions. And I'm going to quickly go through the questions that have popped up now. So that sort of ends the presentation for today, but there are questions that may pertain, or you may also have the same questions, so I'm going to go over them now, and please feel free to continue to type any questions into the chat box. So for a traditional IRA and using a backdoor Roth conversion, how does the taxation work on that? And with some other types of accounts, is that accepted? So I'm going to sum up this question here. If you earn too much money, if you make too much money in a given year, whether you file single or married filing jointly, there is an income restriction in order to be able to contribute directly to a Roth IRA. I don't have those in front of me, so I don't want to say, you know, this is what it is. I don't have those adjusted gross income limits in front of me. If you're married filing jointly, it's around 200,000. But if you exceed income limits, and they do change a little bit every year, if you exceed income limits, you can't contribute directly to a Roth IRA. So in that case, you would contribute to a traditional IRA and use a strategy called a backdoor Roth, where you immediately convert it to Roth. If you have other traditional IRAs in existence, the tax on that is going to be pro rata. So that is very specific. It does apply if you have other traditional IRAs in existence. So if you made a non-deductible contribution and you make do a Roth conversion, then you have a pro rata rule here for how your taxes are going to be owed on that. So it's going to be a 1099. And then you're going to owe some taxes even if that contribution was non-deductible. So again, that's where you want to definitely talk to your accountant. I addressed the income limits. I don't have those numbers in front of me, so I don't want to speculate too much on them, but if you're married filing jointly, it's going to be around 200,000. If you search modified adjusted gross income limits for Roth contributions, that will come up. You can go right to the IRS website. I would recommend making sure that you're looking at the tax year for which you wish to apply that to, because it does go up every year. My contact information is here again in case you need it in order to reach out to me with specific questions. What's the difference between secured and unsecured notes? If you have literally something securing the note, and really, again, this is really a question. I'm going to give you a high level information on this. Is really a question for you know, your attorney, somebody that can help you understand it, especially if you're looking at a specific note with specific security. But at Advanta, a secured note would be something where there is security in the public record. So if you have a note tied to a mortgage or a deed of trust in the public record, so you could go to the property appraiser's website and you can pull up, there is a lien on a property, or secured by non-real estate assets with like a UCC filing, again, secured in the public record. Unsecured, meaning there is no security, but maybe there's a personal guarantee here, or maybe you know, it's a loan to a business or something like that, but there is no mortgage, deed of trust, or UCC filing. And this is, again, kind of how Advanta would look at the note. Now, if there's other types of security, again, that would be a question for an attorney to help you with that. Mortgage loans should be to a qualified person or entity. I'm not sure of the question there. We do not qualify who you're lending money to. It's going to be up to you to do your due diligence on the loan, on the borrower, on the property. If it's a mortgage, meaning it's tied to real estate, if you're looking at a specific investment, Advanta does not qualify that investment for you. So make sure that you are comfortable with it. I had a question pop up about creditor protection. Creditor protection is actually going to depend on the state in which you reside. And so, if you look at your state laws, your IRA is going to be specifically protected depending upon where you live. So I think that is all the questions I had. Again, I have my contact information here. If you are looking to get a copy of the slides, please reach out to me. That is the fastest way for me to get you copies of the slides. I'll make sure to email them back to you. My contact information is here if you have more specific questions. I had a few questions on fees. Please email me. I'm happy to address questions on fees and get you a copy of the fee schedule. But fees are very specific to different types of transactions. Especially, if you're holding real estate versus you're investing through an LLC, or sometimes depending on if it makes more sense for you, we have another option based on the total value of your account. So if you're doing many short-term investments or you're holding many investments depending on the value, it could make more sense for you to go with the second option based on value. So I'm happy to get that information over to you. Again, please email me and let me know kind of what you're looking at doing, and I can give you kind of a breakdown of fees that you can expect, and I'll also include the fee schedule for you. Thank you so much, everyone, for joining us today. Again, this is recorded and we will be sending out the recording, and we hope that you'll join us for many webinars in the future. Take care.